Patel with Palisade Radio. This week's guest is David Skarica, editor of addictedtoprofits.net. At the age of 18, David became the youngest person on record to pass the Canadian Securities course, and at the age of 19, David launched Addicted to Profits, which was ranked 5th out of 300 financial newsletters in overall performance by StockFocus.com. David, welcome on the show.
Thanks for having me.
You made a great comment before the interview while we were talking, and I want to start with that. You said that the difference between the Soviet Union and the United States is just a printing press. What do you mean by that?
Well, see, I'm not really into this whole thing where they were communist and we're capitalist and we won and they lost. I believe that you have certain, you have superpowers and you have economic systems and they fail. And, the British Empire imploded and Rome imploded and the Spanish and French empires imploded and the Soviet Union, which was basically an empire, imploded. So what really happened, and George Soros talks about this when the financial crisis happened, was that the system, which was this debt-based system on ever-growing credit growth, kind of hit an apex in the mid-2000s and then crashed in 2008, 2009, and the authorities had to bail it out. And you can almost argue that in 2009, when everything was about to collapse, that probably a lot of these Western countries' systems almost should have imploded like the Soviet Union did in 1991. But because the United States is the reserve currency of the world and has a printing press and can print as much as it wanted to, the Soviets couldn't do that. And, having a capitalistic system also gives you advantages because you have access to capital to print. The Soviets, again, didn't do that. They didn't have any markets to tap into. Then they could just keep kind of the system afloat. So I think what has happened in the last 5 years is through this quantitative easing and printing of money and the Federal Reserve, going from 500 billion to over 4 trillion on their balance sheet, they've essentially been able to keep this illusion that the system is going and the patient is alive, when really it's kind of dead. 'Cause now this looks like a normal cycle, right? You have a bull market, it's frothy right now, you have tons of mergers and acquisitions going on, and I don't think any of this should have happened if the Federal Reserve didn't expand their balance sheet and print money. We shouldn't have a second dot-com bubble happening right now. So that's what I mean by this. But I think the problem is now when this next crash comes, the average person's kind of already not doing well anyhow. So whatever. But in terms of the financial markets, it's going to be even worse, because what are they going to do if there's another bear market or, there's another smash? The rates are zero. All they can really do is print more money at this point. So, and if you look at, again, when those systems crashed in the Soviet Union and Eastern Bloc, they had 5 to 10 year kind of depressions and recessions to clear out the excesses of communism. And there was excesses. Standards of living were high compared to the worker productivity. Costs of living were way, way, way too low. You could still send a stamp for a penny in 1991 in the Soviet Union right before it collapsed. So those things all had to readjust. In the West, that's probably what we need. Almost similar, on a micro level, was Greece. We probably need to be like Greece and do a lot of cut spending and raise taxes and have standards of living decline for 5 to 7 years before you can get a real recovery. And I think now, unfortunately, the bust is going to be even worse, because the Federal Reserve kept putting off the bust. And just so you know, a lot of this has to do not only with the economic, like I just said, level, is also the government level. With the debts now so high from the bailouts, from this recent downturn, you can't afford rates to go high, because then your interest payments will basically take off your whole budget. And by the way, all empires, and especially in the case of Spain and France, back in the Middle Ages, right before England became the world superpower, that is basically how they imploded. Was that too much debt, their interest payments spiked, and at their peak, they were paying 50 or 60% of their government budgets in interest. And that's essentially what the Fed is trying to put off as well.
And David, in 1999, you published your first book called Stock Market Panic: How to Prosper in the Coming Bear Market. The market subsequently crashed, and you were perfect on the timing. You've now just published another book called Collapse. And before the call, you talked about how you think there could be a correction in the markets as soon as this fall. What indicators are telling you that a correction's right around the corner?
Well, the first is just the price action of the market. One of my favorite analysts and one of the guys I learned a lot from reading about was a guy named Martin Zweig. He wrote a book called Winning on Wall Street. And Martin Zweig, anyhow, his fund made 9% the day of the 1987 crash. And he essentially put 1% of his portfolio into S&P put options in late September because he was worried that the market would fall. And on average, long story short, he sold these put options on average for about a 2,000% gain, a 20-to-1 a gain. And that made his portfolio, hedged his portfolio. And one of the things he talks about in the book is that one thing that really worried him is that there was no 10% correction in the market since mid-1984. So the market had basically gone straight up for 3 years. Sentiment was really bullish, and there was no real pullback, and it basically was going parabolic. Well, that's really what's happened to us since 2011, was that we had the first rally from 2009 to 2011, and we were getting corrections in 10 and 11 because people still, the financial crisis was still fresh in their minds. They were still worried. And then really since QE3 started in late 2012, the market has essentially gone straight up in kind of this parabolic mode, similar to 84 to 87, similar to 35 to 37, which preceded a 50% decline in the market. And so every time you get that period, 2 to 3 years, and it's not just 2 to 3 years without a correction, but 2 to 3 years when the market is basically, doubles in that period, the correction is usually pretty nasty, and not just a correction, but a crash. And one reason you don't want to be the boy who called wolf and always calling for crashes, but the one reason I think it may be a crash and not just a normal bear market, and it might not be like 2000 or 2007 and take a year to top out, is because of the artificial nature of the rally, because of all this liquidity, because of all this money printing. And as they rein it in, once you don't have that liquidity in the market, I think it can implode quicker than people think. And people are so complacent right now, and almost every indicator I watch is showing too much bullishness towards the markets. It really, really worries me. And basically what I consider a crash is a 2 to 3 month period where the market falls roughly 30 to 35%. And could that and seasonally, you tend to get like a July, August top, and then the market will fall into the fall. And that's what we could be setting up for. And of course, many of the momentum sectors like the dot-coms and the biotechs actually peaked back in March.
Talk to our listeners about how the Fed and the government never seem to inflate the same bubble, but rather move to create new bubbles. Why is this, and what will the next bubble be?
I don't know. It's just the way kind of markets work. And actually, this was an error I made. Was that when the Fed began quantitative easing, I thought they were going to reinflate. They were going to deflate the dollar, and that would reinflate kind of like commodities and emerging market bubbles. But those were not bubbles, but they were the bull markets of the mid-2000s along with housing. And where I made a strategic mistake was, no, they recreated not that previous bubble, but that bubble from 2 cycles ago. They recreated the dot-coms, the tech stocks, all of that sort of thing. So if I'm right and there's a kind of crash or a bad bear market, they're going to print more money to fight that again, to fight the deflationary forces. And if I'm right and they're not going to reinflate the dot-com and technology and biotech bubble. What's probably going to happen is, again, the bubble from 2 cycles ago, the commodities bubble, and commodities have building very nice bases for the last year, especially gold and precious metals. I think that is where the money is going to flow. I don't know why it happens, but it's just the way the money flows. That it's like pushing on a string. Because I think it's more because investors' memories, they just got burned in that previous asset class. So they're going to look for another asset class when there's all this liquidity in the market. And this time I really think it's going to be gold and precious metals. And remember, one of the bubbles we have right now, and this is a thing really positive going forward for gold, is we essentially have a confidence bubble in the Federal Reserve, where everyone thinks that they can just keep rates at zero and print money, and there's nowhere else to put your money because you don't get any return on capital and in interest. And then they can keep pushing the market 10 to 15% higher a year, and everyone believes in them right now. But once you get a bad decline in the market, and then they have to respond with more QE, I think that confidence bubble gets burst, and then the inconfidence bubble basically inflates gold and precious metals, which are the hedges against lack of confidence in the government.
And David, gold or silver or metals or mining stocks, where should investors allocate funds to take advantage of this new bubble that the Fed's going to create?
If you're going to buy physical, I prefer silver here because I know some people argue that silver is industrial uses, but silver is more of a precious metal. It's the cents if if gold was the dollars in exchanging, right? So I would prefer silver. The gold to silver ratio is, like roughly 65 to 1, which makes silver quite cheap. So I prefer, if you're going to buy physical, buy silver. But I actually prefer the miners as a whole because they really were decimated, especially the junior miners in this last downturn. And there's a study I talk about in my book Collapse by Mebane Faber, and he talks about what happens to industries or sectors when they fall a lot in price. And when a sector falls 80 or 90% in price, and the GDXJ, the junior gold miners, have fallen about 80% from their high to their low, the average 3-year return on that sector will be anywhere between 150 to 200%. We're already maybe 30, 40% off the lows, so we're in the early stages of it. But that would tell me, and this happened in Greece, this happened in 2009, many sectors in the U.S. stock market, that probably we're going to set up for a very good 2 to 3 year return. And because this is where you're taking advantage of how badly run a lot of the gold stocks are in terms of the cost of production's gone way out of control and the cost of, implementing a mine's gone out of control. But that also means that they have small margins here at 1,300, but that gives you more leverage as gold goes up to 15, 16, 18, 19, 2000. So I think the miners are actually really the way to play it, I think, as of now. And like I said, if you're going to buy the physical, I prefer silver.
You've seen a few cycles play out in the mining stocks, and you told me that you have some stocks in your portfolio that are trading at 2 or 3 cents. And based on your experience with previous cycles, these can be the stocks that perform the best. The bigger mining companies are already moving a bit, but when can investors expect these smaller companies to start moving?
I usually find it's about a year lag. Like I remember when I was investing in gold stocks back in 2000, 2001, it was about 02, 03 where the juniors really started to outperform. And I don't mean junior producers, I mean the actual junior miners. So I would think that by early next year, we could see a very good market in the junior miners. If I'm right, and now seasonally we're in a very strong time for the precious metals, being the summer, and we get this rally, this typical summer rally, maybe a fall correction, and then a rally into the end of the year, and gold finishes the year 14, 1500 or higher. I think that is when the juniors will start recreating interest. And because, remember, we're in a super cycle for gold right now. This was not like the 80s and 90s when they had booms and busts and you were in a secular bear market for gold. Gold itself is in a secular bull market. Remember, gold went from 250 to 1900. So look at it this way. Gold is like a stock that went from $2.50 to $19, back down to $13. And now, if you owned a stock that did that, you would think it was just like in a consolidation. And I like to credit a guy named Mr. Skin who writes on Bill Fleckenstein's side, who kind of pointed it out in those kind of layman terms like that. But that is the way you got to kind of look at gold and precious metals. But the stocks, so because of the super cycle, a lot of these juniors have been working on these properties now for 5 or 10 years, and they just kind of need one more upcycle in some of these properties to be able to raise capital to make the property economic, etc. So this isn't like the mid-90s when maybe a property hadn't been worked on for 20 years and they were starting it up again because metal prices were so low. Like now, a lot of these properties and a lot of these companies, through the last 10 years or 15 years of this junior cycle, have actually built up ounces in the ground, have stuff there, but they just need another upturn to basically get access to capital and raise money and be able to put these things into production or really ramp up the size of the property. And that's the nice advantage right now. Is like, if you would have told me gold would be 1,300 and the junior market would be acting like it was when it was 300 15 years ago, I would have never believed it. But that's exactly what's happened. But it's also brought out a lot of value. And that's kind of what I really do. I'm not a total gold bug, but I was looking at Greece in 2012. I was looking at automakers or automobile stocks, and casinos in 2009 in the U.S. And now I'm kind of looking at the gold and precious metal sector as being the sector that's very undervalued.
You know, right now can be a very frustrating time for the die-hard gold bugs because many of them have lost most of the money because they were invested heavily in the junior stocks, and now they have to watch the bigger stocks begin to move while the juniors, many of the micro-cap juniors, are still dropping. Your advice at this point is to hold on and keep buying in order to get the biggest gains at the end of the day?
The juniors, no, I would actually kind of go twofold. I'd like small producers, so junior producers. You know, a company that, say, has one property, has good cash flow for the property. Those are the kind of companies I find in the upturn. Like one of the companies I owned during the first phase of the bull market in the early 2000s was Eldorado, which went from 40 cents and essentially ultimately actually went to $20, right? So, by the way, I didn't buy 40 and sell at $20, but that just showing you the kind of gains you get from like a smaller kind of intermediate producer. And with those juniors, though, you also have to be very selective in terms of the management, what they have actually in the ground, can they survive? These are things you all have to take into account. But if they have a good property and they already have ounces in the ground, and they just basically got to wait it out until the markets can, return, like a positive market return in the gold and precious metal sector. Yeah, those are where your biggest gains are going to come. That's where actually you maybe not even get stocks going up 1,000%, but 5 or 10,000%. And I'll give you a quick example of one stock because it doesn't trade anymore. Is one of the stocks I recommended in my newsletter in early 2009 was Avion Gold, which was in Mali. And they were just putting a gold mine into production. It was a junior and had been totally beat up during the financial crisis. And long story short, it went from 6 cents to as high as $2, and it was eventually taken out for about 90 cents a share. So those are the kind of gains you can get in the junior sector. And another thing about junior investors, let me add in about this. This is the time to buy. I believe in, like my mentor is John Templeton, and I believe in buying maximum pessimism, what he used to call it. And one thing I've learned from these cycles, because I've made money and lost money in these gold and precious metal cycles, is I have no interest in chasing these things. So right now, maybe over the next year, I'll be buying juniors. But once we get 2-3 years into the cycle, even if it's hot, even if it's going to run up, I got no interest in adding to my positions. I'll just be slowly taking money off the table. But this is totally the time to buy. I know it's frustrating and they've gone down a lot, but again, they're that may be in favor study I mentioned earlier. These stocks are down 80 to 90%, and usually as long as they survive, they should do well going forward after this.
David, thanks so much for coming on the show. We'll definitely get you back on soon. Where can investors go to purchase your newest book, Collapse?
Go to Amazon.com. Right now, it's just an ebook. I'm actually just about to get the physical version underway. But go to Amazon.com. Just type in my name on Amazon, David Skarica, Skarica, and it will show up. And you can go to my website at addictedtoprofits.net.
All right, David. Thanks so much.